Before we begin, a quick disclaimer. This podcast is for entertainment and information purposes only. It should not be relied upon as a base for any investment decision. For solicitation or to buy or sell any security, either the host, guests, or clients of either may own securities discussed on this podcast. Welcome to another episode of the Special Situation Report. Today I've got a very special guest. Welcome Patti Cook. She's the CEO of Finance of America and soon to go public. Welcome.
Yeah, thank you, Bram. Great to be here.
No, thanks for coming on. I'm very excited to be able to ask you some questions. Maybe the most best thing is if you could tell us about your background and your career before you became the CEO of Finance of America. This is always interesting for people to get an idea of what you've been working on. And
I've got to be careful to summarize it because it's a 40-year career. So it's been a long time, and I'll say it wasn't a straight shot. In college, I was an education major. So I got out of school, I taught for a short period of time, and I wanted to do something else. So I went to my parents and I said, I want to get an MBA. And they're like, really? Okay. This was 1977. So I went to NYU. And when I got out, women MBAs were in very short supply. So the job market was fantastic. I was lucky enough to get hired at Salomon Brothers in 1979, and I spent 12 years there. And it was fascinating. If you go back and look at that decade of innovation in the fixed income markets, it was spectacular. And it really continued through the 90s into the early 2000s. If you think about it, when I was at Salomon, there really wasn't a mortgage-backed securities market. It was brand new. And mortgage rates were at 16%. So it's just interesting to look at the beginning and look at where we are today. And during that time period, what I've witnessed in terms of innovation and the reduction in rates is pretty spectacular. My last job at Salomon Brothers was I was their fixed income strategist. And I then got hired by a customer of theirs to manage a mortgage portfolio. That was Fisher Francis Trees and Watts. I went in as a partner for portfolio management. From there, I was recruited to Pru to be their chief investment officer. And from there, I was recruited to JP Morgan to run their fixed income asset management business. The pivot from asset management into, I'd say, more business management happened at Freddie Mac. Because my first job at Freddie Mac was to manage the retained portfolio, which was an investment job. But quickly, they added for me, I managed the single family business, the multifamily business, and that's really where I got more into the operation of things. Post conservatorship, Brian Lippman, who's the founder of Finance of America, recruited me to launch a company called Greentree, which was in the specialty servicing business. I stayed there for several years, and then Brian recruited me to Finance of America in March of 2016. And I have to tell you, I feel so privileged, right, to sit in this seat that I'm in today and have this opportunity at what is the end of my career, right? I'm 40. At some point, I have to retire. And this has just been an amazing experience, and I'm very excited about the future. And last thing I'd say about all of that is during that time period, I had 3 children. And it was a bit of a joke at Salomon Brothers that I was the woman that had the most maternity leaves of anybody that had ever worked there. So that was kind of fun too.
Yeah, that's funny. But so Salomon Brothers, for maybe younger listeners, it was maybe the Goldman Sachs of today.
Oh, definitely. They were the rock and roller of fixed income. Yeah. And the great thing about Salomon, when you look at it, is the people they hired were from all walks of life, right? They just hired an aggressive, ambitious, relatively young group, and we were at the top of the heap. And a lot of that was because you think of Salomon Brothers as primarily fixed income, and it was just a heyday of innovation. They were later, ultimately, Salomon Brothers was bought by Citibank.
Oh, right. Okay. And yeah, if I'm, I sometimes I wasn't investing at that time, but I read investment, history, and then like at Goldman Sachs, they would hire people by playing bridge or poker against them. You know, the industry changed, I
It
think.
totally did. I mean, we
Yeah.
used to play a game around money supply, right? And what
Right.
money supply was going to come out, because that was the big monetary benchmark that everybody was
It
looking at.
sounds really nerdy.
And then we would play cards like poker with a dollar bill based on the numbers that were dealt.
Right.
So there was a culture of risk taking.
Right. And that's also in like the Michael Lewis, I
Yeah,
think,
oh,
the movie.
absolutely. He
And
was there when I was there.
okay, cool.
I actually worked. He referred to a guy in his book called John Merriweather, who was my boss for a period of time at Solomon Brothers.
Oh, so cool. And yeah, well, you had some amazing investment jobs there. And in fixed income, I think that was like the cool thing in those times too. Like equities are now, they're roaring. So I think people.
Right, exactly.
Yeah.
Fixed income was the market to be in. And if you think about it, the first securitization outside of MBSs was CMOs, which turned into REMICs. And if you look at the innovation in interest rate swaps, I remember when they were designed, right? It was probably, I don't know, the mid 80s. So the innovation created so much opportunity, both for investors and Wall Street.
Yeah. And so I'm sorry if it gets too personal. I just
No, go
tell
ahead.
me so. But because you made that joke about your maternity leave, but was it like a hard time to be a woman and make your career, or
You
you
know, a
didn't?
lot of people ask me that, Brom, and I've got to be honest. I didn't for 1 minute feel that I was being, quote, discriminated against. Like, I really thought, you come into work every day and you do a great job and you're going to get noticed and you're going to get rewarded. So I didn't see, and still don't see, any sort of, you'll call it a glass ceiling for women. Like, obviously, no, look where I am, right? It's kind of amazing.
Yeah.
So no, I didn't feel isolated or ostracized in any way being a woman, nor did I feel it hampered my opportunity.
Oh, well, that's great to hear. And yeah, maybe it helps that you were in business with a profit and loss, and I'm sure that gives a certain objectivity. Yeah.
No, that's a great point, because you did live and die by your P&L and your results. You were held accountable for them.
Yeah, nobody's going to fire somebody who's a real rainmaker, I guess you would say. So, and then when you switch to like more of operational roles, is it something you aspired to, or was it sort of how things went, or?
The interesting thing, and I love to mentor young professionals, because if somebody were to have told me in 1980 that I would end up as the CEO of a public lending company, like, I wouldn't have seen that path. So some of it is you take advantage of the opportunities as they're presented to you. And then I think in the process, you learn a lot about what you're good at. So what I learned at Freddie Mac is I loved operations. I loved creating teams. I loved making them more efficient. I loved trying to figure out how to be best at it. So coming to Finance of America, I love being able to leverage call it my quantitative or my capital market skills, but I absolutely love running a business.
Okay. And what are like the key differences between the time that you were on the chief investment officer?
I'd say when you get to be a CEO, it's the culture of the company. It's the people. How do you create an environment that brings out the best in people? Because at the end of the day, that is what determines your success. So, and I love that. I love people. I love mentoring. And I've loved watching us at Finance of America. We were designed from a clean sheet of paper. There was nothing there. We bought companies and we integrated them. And how you do that and how you build a culture was challenging but exciting. And I'm, today very proud of where we are.
And when you got there in 2016, right?
Yes.
It was already a decently large organization, or?
Well, it was, but there's actually a chart in one of our investment decks that shows the acquisitions we made. Mm-hmm. So I'd say from the formation of the company in 2013 through 2015, we were acquiring companies. When I came on the scene, the goal was, okay, you've got to make this an efficient working machine. This can't be a collection of 15 companies that are operating on their own. We had to merge them together. And that really took from, I'd say 2016 through 2018 to really get that right. It was simple things. If you buy a couple mortgage companies, they each have their loan origination system. Well, right, we bought 4 mortgage companies. You can't have 4 loan origination systems. You have to have 1. So that migration of the infrastructure and the cost that we had to take out to make us a well-run company occupied our time during that time period. Okay. And I think, I'm sure as we go through this interview, you'll see that where we are today, right, and what we're looking to do in the future is very different than what we were doing up until, I'd say, 2019.
Okay, but I'm really interested in learning more about your M&A strategy and the acquisitions you did. Maybe if we can take one step back, and can you explain what Finance of America does? Because it is, maybe a slightly alternative finance company.
It is, yes. So if you go back and you look at the management team, many of us spent the better part of our career in mortgages, and mortgages can be a pretty volatile asset class, right? Historically, it was a little bit boom and bust, right? You have years of huge volume, years of low volume. And while we love mortgages as a business, we wanted to form a consumer lending company that could stand the test of time, that would be there in good cycles and bad, and still be able to grow earnings. So we set out to build a company that would grow cycle-resistant earnings. So when we looked at and that's different. If I can just pause for a second, if somebody was going to compare us to a mortgage-only lender, you're going to see a very different platform, right? Rocket is a great company. They have great technology and they have a great brand. But that's all they do. They do mortgage. So when we were creating Finance of America, we wanted to build a company that was diversified and differentiated. So when you look at the acquisitions we made, that guiding principle told us to diversify. So we are a consumer lending company. We have 3 big products that we lend. Your traditional mortgage, 30-year, fixed rate, floating, mortgage for a residential property. We have something called a reverse mortgage, which is aimed at the population 62 and over. And then we have something we refer to as commercial, but what we're really doing there is lending to those that want to invest in single family or, 4-person dwelling kind of homes, either fix and flip them or term finance them. So at the very beginning, the acquisitions were driven by creating a company that would have those 3 lending segments because they're diversified. They all don't go up and down at the same time.
Yeah. And then like Rocket is, I think, your competitor with maybe the sexiest reputation in terms of online only.
Yep.
And like a little bit of a venture thing. But you have like a diversified distribution structure as well.
Yes.
And yeah, that's also pretty complex if you're for an outsider. Could you maybe
I'd love to
explain how it meshes together?
Yes. So you're right. Rocket is all about the digital platform, and they're looking to get their leads digitally, right? You have a big brand, they go to the website, they find Rocket, they do a mortgage. All right, we go to the market 3 different ways. Okay, one is we have a small digital platform, similar to Rocket's, but it's small. We
So it's
have
not
a,
all your products, or are there a few
so I'll
people
get to
going
that
there?
in a minute. Let's come back because that's another interesting part. But let's
Okay.
look at the distribution channels first. Okay, then we have a broker channel. So we've got like 1,200 active brokers, and that business compares to UWM, which is another mortgage originator. They've recently gone public, and all they do is get their leads from brokers. For us, the differentiator and the icing on the cake is that we have distributed retail. That means we have branches all over the country, branded Finance of America, with our own loan officers sitting in those branches. They get leads from their local realtor. Okay, now to put this in perspective, let me give you a couple statistics. First of all, 90% of the people in the United States that buy a home still use a realtor. And the realtor and the borrower want nothing more than to make sure they get a mortgage and that it closes on time. So as our LOs develop that relationship with that broker or with that realtor and also with the customer, it has been a tremendous purchase business for us. So today, okay, the market is probably 65% refi, 35% purchase. In January of 2019, our platform was 65% purchase, 35% refi. So as we go into this market and everybody's wringing their hands over rates are rising, refis are going to go down, what's going to happen? I'm not saying we'll be unaffected by it, but our platform was built to be in a better position to withstand it.
All right. Well, we'll have to see if rates rise, but that's really interesting.
So we can do both. Like I love the fact that we've got purchase and we've got refi.
Okay. And then can you maybe tell me a little bit more about what the refinancing market looks like? Is it less profitable than like an initial deal?
Not really. I mean, they're both, refis are very profitable. Sometimes the rate might be a little bit lower for a refi, but the cost of doing a refi is a little lower. So I don't really look at a differentiation between the profitability of one versus the other.
Yeah, and there can be real painful if you hold a lot of mortgages, if I'm not mistaken, but I'm not a mortgage expert at all. But you're not holding a lot, right? Or a lot of...
No, so we talk about being in the moving business and not the storage business. And what that means is we're originating loans to sell them, right? We are not, and one of the things that I haven't mentioned is that in addition to the three lending segments, forward, reverse, and commercial, we have another segment which is called portfolio management. And what they do is anything that we're not selling to the agencies, Freddie, Fannie, Ginnie, they're selling to private investors. So our proprietary products, the new things that we're launching, they are distributing either through securitizations or to end investors. We are not balance sheet heavy. We are not retaining loans.
And yeah, maybe it's a little bit of an obvious question, but why are the big players not taking it? Is it too risky for them, or?
You know, I think everybody, you know, you look at the people we're selling the loans to. Okay, well, who are they? They could be large pension funds, sovereign wealth funds, hedge funds, whose business is to own those assets. That's not our business, right? We're an originator. We want to originate loans and sell them. But there are plenty, I mean, there's so much capital in the market today, and there's a dearth of opportunity. So one of the things we love about our platform is we've got this great distribution on the front end. So we know what people want, and we have great distribution on the back end, 100 private investors. So we can create product that meets both. We launched a fabulous product in reverse called HomeSafe, which is a jumbo reverse product that is best in class. And most other lenders do not have that back end capital markets that we do. It's been
Right.
a hallmark of ours is innovation of, organic products.
And is that does that help you to like keep growing because your growth rate is pretty high across the your competitors?
It definitely does. It
Okay.
definitely helps us grow.
Because you can get it out of the door and then you can take on new originate new loans.
Right.
Okay, that's interesting. And then you said brokers were one of your distributors. I'm not exactly sure what a broker is, like in this.
Sure.
Okay.
A broker is his own operator, right?
Okay.
Basically, he's not tied to a lender. So he's out there drumming up business. He then takes his loan to a lender to actually make the loan. So he's almost like a free agent. RLOs, if you think about that branch network, and I said we had 1,000 LOs or 1,200 LOs, they work for Finance of America only. A broker could find a borrower and he could take that loan to anybody. He could bring it to us. He or she could bring it to UWM. So they're sort of a free agent.
Free agents. All right. And then maybe the next thing to break out is how your products are distributed across your organization.
Yeah.
And maybe if we could spend a little bit of time on the reverse mortgage, because I think that's a real interesting, it's kind of a new product that's really suitable for these times. And that's, yeah, I mean, you've got great growth numbers in that product, and I think that makes a lot of sense.
So in terms of the distribution, all of our products are distributed through all of our channels.
Oh.
And that's another great advantage. So, and I'm going to give you an example and tie it back to reverse. So if you look at well, first let me explain what a reverse is, and then I'll connect the distribution dots, if that's okay. All right, so a reverse product is aimed for the population, basically 62 or over. So it's baby boomers like myself, who many of which have not saved enough for retirement, and yet they want to age in place and stay in their home. If you look at their balance sheet, a huge percent of their wealth is tied up in their home. So what a reverse mortgage does is it essentially allows them to monetize the equity in their home. So when you do a reverse mortgage, depending on your age and depending on the LTV of the mortgage, we will allow you to draw. It's similar in a way to a home equity loan, but you never make a payment. And then at the end, when you either are moving or someone passes away, you pay off the bank and anything left goes back to the owner. So, and rates are low, so you're borrowing that money at a great rate. I mean, it is really a great product. It got off to a bad start. Initially, reverse mortgages were only a HECM product by Ginnie Mae, and the product was poorly designed, and it got a bad rap.
You called it a HECM product?
A HECM, a home equity, cash.
Okay,
mortgage.
so it was
It's an acronym for Ginnie Mae's product.
Okay.
And it was poorly constructed, and it got kind of a bad name. Coming out of the crisis, Ginnie Mae in 2015 restructured that product in a way that was much more consumer friendly. So I'll give you an example. Stanford has something called the Center for Longevity, and they are now writing papers that are positive about reverse and the tool that it can be for people in retirement.
Right.
The thing that we love about it is if you look at something like the UK, something like 25% of their population over 62 have a reverse mortgage. In ours, it's tiny. It's maybe a couple percent. So we think over time, the adoption of the product will grow. And you can see how that's got nothing to do with mortgages, who are very much tied to rates. The reverse isn't tied to rates.
Right. And is that product risky in a different sense? Is that maybe like a strange set of homes that you're taking over as an asset, or
No, not really. I mean, it's the same. It's the same borrowers so here's where I was going to go with the distribution and the cross sell. It's the same borrowers that have a mortgage. So we looked at all of the people that we did for years in our mortgage business. So let's go back to those LOs for a second and just dumbing it down. Look at all the people that they did a mortgage with. We looked at the population and said, how many of them are 62 or over? Because then we're going to analyze the mortgage they have relative to what might be available in reverse, and we're going to go back to them and point out that opportunity. So there's a great example of the power of the platform to allow us to distribute reverse in what has traditionally been like a straightforward mortgage business.
right? And you also mentioned that like Stanford is now positive after the products are structured in a different way.
At the Center for Longevity, they've written some papers that are quite attractive.
All right. And because there's a little bit of headline risk if you're kicking out.
Oh, it's terrible. I mean, we do. So our motto is customers first, last, and always. And I will tell you, if you look at our statistics, particularly in our proprietary product, like we're not pushing people out of homes. We're finding a way to renegotiate. We're finding a way to keep them there because the headlines are, not only are they devastating, we don't want to do that. So we want to be active with them and trying to find ways to restructure, sell the property over a reasonable period of time. We're certainly not putting people out on the pavement.
Right. Yeah. So that's great. Let's see. So we're briefly out, but now we're back. Patti, I wanted to still know more about your M&A strategy because the company's done like 15 deals, I think, since 2013.
Yes. Yep.
Were you around for all of those or many of those?
I was around for many.
Okay.
And integrating the big ones, and we're still doing some. So it's a big part of what I do.
And big ones, does that mean that they were like equally sized to your existing operation or like half the size? Or?
So remember, we started at zero, right? So there was nothing.
Mm-hmm.
I would say our two biggest acquisitions would be in the mortgage business. We bought a large originator on the West Coast and a large originator on the East Coast. So, and we also made a fairly large acquisition in the fix and flip and investor-owned property.
All right.
But excuse me, here's what I'd say about it going forward. I mean, we just announced, God, it was yesterday, that we bought a small company called Renovate America. We were the stalking horse bid for it in bankruptcy. And that company does home improvement loans, which we are so excited about because think about how complementary that is to our existing business, right? So if we've done a mortgage, right, and somebody wants to rehab their home, right, they know to come back to us. We can now offer them a product. If somebody is selling their home, we call it fluff and buff, and they want to fix it up, we now have a product we can offer them. So you will see Finance of America continue to do strategic acquisitions, things that complement, excuse me, things that complement what we have today and further the strategic objective of generating cycle-resistant earnings. So the more diversified we can be, right, the better. So we'll never be done with acquisitions. We're going to grow organically, but we are also going to grow in a disciplined way through appropriate acquisitions.
Right. And you were talking about that. That's one of the things you really liked about the executive side. It was like the people work and building the culture. That is a really hard thing with M&A, and the track record is mixed at best across all companies. I think in finance could be especially hard. Like the cultures can be very different. You've been at
They
Salomon
can.
Brothers. I mean,
Yep.
yeah,
No, you're right. It's
yeah.
hard. And I think it was harder at first. Like, I don't think it's as hard now
Mhm.
because we're more established. Now we have a culture of our own. But when you were doing those first acquisitions, you didn't, right? By definition, we were a handful of people starting a company. Now we
Mhm.
had a view of what we wanted our culture to be. And that was our sort of guiding principle: customers first, last, and always. And we want to grow cycle resistant earnings. So we had in our head a culture, but making it real and bringing those disparate companies together was hard. You can imagine, though, that by the 15th, we were a whole lot better at it than we were when we did the 5th. And I
Right.
think we've built a platform, right, from an infrastructure platform. We now know how to onboard people, right? And the decisions you have to make right up front about your data center, the kind of computer they have, the network in the office. So there was I'm sure, a learning curve for all of us. But at this point, we've got a great playbook on how to acquire and integrate.
And because it looks to me from a cursory review of the track record that you're pretty opportunistic or smart about acquisitions.
We think so.
Okay. But maybe that is a little bit of a conflict of like screening very hard for like a matching culture. So how do you think about that, or how do you manage that?
I mean, we can tell up front, we view our acquisitions as partnerships, right? And if we don't see eye to eye up front, if we're not aligned on the vision and what we want to do, then we're not going to acquire. So it's as much about the people and our ability to work with them and their desire to work with us,
Hmm.
right? So we won't go down a path if we don't think they can be brought on to our platform and culture in a way that's constructive for everybody.
And then yeah, I'm real interested in your customer first strategy. I
Mm-hmm.
think, it's a strategy that's been around, but it's lately
I,
exemplified by Amazon, maybe, who's made a religion out of it. Yeah, I think a lot of people love it. But what does it mean, like, for you in a finance business? Because people don't really love, like, mortgages. You just want to, mo-
that's right. You don't dream about a mortgage, but you do
ah,
dream
yeah,
about a new house or a second home.
for sure. Yeah, for sure. Yeah.
So the way we think about it, we did a survey in 2016. It was a consumer survey. This was actually targeted at millennials. And we asked them what they wanted in a mortgage advisor. And what came back was really interesting. Everybody says, oh, they want technology. They want technology. Yeah, they expect technology. They expect that the mortgage process is going to be easy. It's table stakes. If you can't do that, don't even bother trying to get the millennial. But for everybody that has good technology, they said two things, and they said it over and over again. They wanted a trusted advisor and they wanted a human touch. And we are committed to delivering that. I'm incredibly proud. People track like their net promoter score, right? After you do a mortgage, go back, you survey everybody and you get feedback. And our net promoter score is above 90. Like right now it's about 97. We live what we say. So it's all about service. It's all about how many of our borrowers did their first mortgage with us and came back and did their second without us even soliciting them. So we look at customer complaints, and the customer, from our perspective, honestly, is always right. You're not going to argue with a customer. If they think something went wrong in the process, we're not going to debate it with them. We're going to fix it. So we live it. It's a hallmark, and we reward our employees when we see people that go above and beyond.
And well, I'm in the financial industry. I try to be customer friendly too, but it's sometimes really hard to do so with the regulation that's coming at you. And I also experience it as a customer that sometimes I get treatment that I think this is impossible, but I know why it's happening. Uh, yeah, how do you balance that, or is that a conflict or a problem
I
at all?
think the
Or?
process is I think the process has gotten a lot easier.
Yeah.
Despite, I mean, there is a lot of red tape when you're getting a mortgage. There's disclosure, and that was all instituted by the CFPB to protect borrowers. From our perspective, over time, much of that is being automated. So, you know, getting your documents to us, uploading the things that you need to do, us getting back to you the things you need to sign, much of the process is becoming digital. It's a lot easier to do than it was, and a lot of it is mobile enabled. So I think the process today is easier, and it's getting easier. I mean, we're even looking at, you know, the whole getting something notarized, right, in
Mm-hmm.
the U.S. and how we make that an easier process. The whole industry is looking at it. So yes, mortgages are complicated. They're heavily regulated, but I think the process is easier today than it was 10 years ago,
All
for
right.
sure.
And then, you're making all these acquisitions, have a great strategy, but then you have to bring in the tech infrastructure, and you're a new company, so maybe it's a little bit of a, you know, state of the art. But how does that work, and does it work?
So it does work, but I think I'd go back. It works because we learned, right? I'm not sure if you go back and look at our early acquisitions that we made some of the best decisions, but now with maturity and a more advanced infrastructure, it is easier for us to do.
All right.
And we pride ourselves, we call our shared services group BXO, which stands for Business Excellence. And that group is incredibly important because for all the innovation, for all the acquisitions we're doing, to your point, Rom, if you don't put that on a good platform, it's not going to work well. You have to be efficient and it has to be cost effective, which we are.
Yeah. All right. And you've got a wide range of products. What are like some of your favorite lines of business that you think you're going to do great on, or that are really the future of finance for America?
Yeah, I mean, I love them all, but one we didn't talk about is we have a subsidiary called Incenter. And Incenter is not a lending company. It is a fee-for-service company. What do I mean? We own a title company and we own an appraisal company. That has two benefits. The title company is called Boston National Title. They're doing title for the top 10 financial institutions in the country,
And that
as well
sort
as
of
doing,
means you administer who owns something, right?
yeah, every time you get a mortgage, you got to verify title. So there are companies that'll do that for you, and that's what B&T does. But for purposes of this discussion, what's interesting is within Incenter, 75% of their revenue comes from third parties. 25% of their revenue comes from our own lending businesses. So if you think about it in our mortgage business or in our commercial business, if we need title, we can use B&T and we keep that fee within the ecosystem. But what's even more powerful is this is a business that's got nothing to do with lending, really. So all their revenue is additive. So go back to the idea of being cycle resistant, the ups and downs of the mortgage market. This is a separate business, fee for service, and it allows us to generate more revenue per loan than our competitors that don't have that business, and it's uncorrelated.
Wow.
So,
So
and that's growing pretty rapidly.
yeah, and if I'm not mistaken, that is a great business. There are a few publicly traded competitors, um, but I
Whoops, you
think
broke up.
it is very geographic, geographical, or maybe hard to scale. Do you think it will scale with your organization?
Oh, you mean Incenter or the
The title.
organization?
I meant the
Oh,
titling
title. B&T
specifically.
is all over the country. B&T
Right.
is
Okay.
huge.
Yeah, because the rules are like different in every state? Is that a true statement or?
Actually, I'm not going to be the
Okay.
expert on getting into the nitty gritty of,
Okay.
but how variable it is by state. But I would say this, we are a national title company for
All
sure.
right. Okay. That's I'm going
So
to
when you
learn
look
more
at
about it.
the 5 businesses though, right? I mean,
Yes.
this is the thing I want people to understand, because if someone's going to look at Finance of America and compare us to another lender, what I want them to remember is there are 5 business segments. You got a mortgage company, you got a reverse company, you got a commercial lending company, you've got portfolio management, and you have in the center fee for service. And that collection, and now we're adding home improvement loans. Right. So you're going to continue to see us build this differentiated and diversified lending business. And that's what makes us different. You know what's hard about it? You know, who are our comps? So if you have people listening to this call and they're going to go say, oh, I'll take a look at Finance America, who am I going to compare them to? It's kind of hard. You probably start by looking at other mortgage lenders, and that's probably a healthy exercise because it'll highlight why we're different.
Yeah. Yeah. That's I
And I
know.
think right now, our valuation doesn't reflect it, right? If you look at the valuation we are today, we're small, you know, in the big scheme of things, you
Yeah.
know, 2 billion market cap company. The multiple to 2021 earnings is low, like it's in the 4s. And I think it's because the story needs to get told. And as people watch us quarter over quarter, we expect that to improve.
And is that why you're only like coming public with like a small slice of the company, or?
Yeah, I mean, the management team is in for a meaningful amount and also participated in the PIPE. So we believe in the company. We love that story. But the reason you want to go public is so that we're confident we have the access to capital in the equity markets and the access to debt, right, in the debt markets to fuel the growth that, you know, we see that may be available for us. The interesting thing is we generate a fair amount of cash. Pretty
Mm-hmm.
much 80% of our earnings are cash, but nonetheless, the flexibility of being a public company is significant.
Right, because I think you wanted to retain like, or no, that's not putting it right, but you thought you needed like 20% of that operating cash to grow, right? To fuel the organic growth.
Yeah, actually, right. So, and if you look at it, there's a lot left over to be
Mm-hmm.
able to do acquisitions. But having said that, right, that's today. We pride ourselves on being a positive cash generator, but the access to the capital markets is still important. And it's interesting. At the beginning of end of 2019, we thought we were ready to go public. So we were going down this path anyway. We picked a SPAC, really for the particular SPAC that approached us because the sponsors, their pedigree is unmatched. And we thought that endorsement was accretive to Finance of America.
Right. Yeah, it is, and they are also they structured their promo with milestones, which
Yep,
is not
they did.
typical.
Right.
So together with the management buying in, and I think your major shareholder is
Blackstone.
Blackstone, right?
Mhm.
And they're keeping most of their investment, but like,
Yeah, between Blackstone and management, we're retaining 70% of the company.
yeah. So that's
So Blackstone still has a meaningful stake, as does the management team. And Blackstone has been just a terrific partner.
right, and they've been with the company for a long time,
The
or
beginning, it
since
was
the beginning.
Brian Littman, who's our founder and now chairman of the board, and Blackstone that were responsible for the funding in the very beginning.
Right. They wanted to. They saw opportunity in alternative lending, where private equity has been really busy for the
Yeah,
last
very. But the
decade.
thing I love about it, like we started with a clean sheet of paper, right? It was an idea, it was a vision. And that's what's so exciting about it, is that we got to this point in a relatively short period of time. And now we're so well positioned to grow from here. So I think I said this in the beginning, you know, I love where we've come. It's been an exciting journey, but when I look at what we can do now, it's almost like the fun is really starting.
Yeah.
Right? We have a great business, and now to be able to grow that and take it to the next level is just wonderful.
Yeah, and then maybe I want to ask about one of those growing businesses, commercial, your commercial business, and that's growing 8%.
It looks like your computer froze.
Oh.
Can you start over? You froze there for me for a second.
Sure. I'll pause a little bit. Yeah, now it seems to be clearing up.
Yeah.
I was just asking you, your commercial arm is growing at 8%. It's like a good segment for you. That's a lot.
Actually, can we pause there for a second? So the commercial segment this year is interesting because when COVID hit in March, we made a couple of strategic decisions quickly. One was we were uncertain about the economic environment and therefore uncertain about the credit of commercial, and we pulled back. We stopped originating for a few months. At the same time, we pivoted some resources to mortgage because we knew this was turning into a once-in-a-lifetime opportunity. And we also decided at that point to retain something called MSR. But if you go back to commercial, we relaunched that product in July. And if you look at our 21 and our 22 forecast, we're just getting commercial back up to where they were on a run rate basis prior to COVID. So the earnings for this year relative to last year look off, and therefore the growth not there because of the pause due to COVID.
Wow.
But
And so
it's regrouping already.
and you
Back in
don't
our
sound,
run rate. Sorry.
no, please. You don't sound worried at all about economy, or that maybe COVID will have like a lasting impact, or you think that administration will do enough to get the economy through?
Yeah, I do. I mean, I think the economic outlook is, you know, with all the stimulus the Fed and the government are providing, is likely going to be pretty strong. And I think the fundamentals for housing remain strong, right? We're coming into a bit of a bubble with millennials that are going to want to buy a home, and the housing stock is smaller. It's too small, right? Housing starts are too slow, and it's old. So there's a lot of demand and work that needs to be done to satisfy the demand, which again is why I love our platform. It's a purchase-driven platform, and that's the kind of market we're heading into.
All right. Okay. Yeah, I think this has been real fascinating and real educational for me. I think we should end it here.
Yep.
So thank you very much for coming on and explaining this your story to me. If people want to find out more about Finance of America, where can they go to?
Oh, actually, that's a good question. So I don't know whether they go to our website. And that is where they should go, because as we become public, I'd have to see what's there now, but that's where we'll be publishing information, you know, earnings information, obviously, investor decks so I would say they go there.
Oh, right, because there's not yet an like investor relations.
We have it, but it's really just kind of getting going.
Oh, okay. So that's interesting.
But you know what? I'm going to send you an email with a little bit more direction on the answer to that question.
Okay, cool. And are you by any accident Twitter user like many CEOs are these days, or do I have to wait for that?
Say that again.
Or I'll have to wait for that for.
Wait, I didn't hear the beginning of the question.
Oh, if you are a Twitter user like many other CEOs these days.
A what CEO?
Twitter.
Oh, a trader.
No, Twitter user. Like Elon Musk is on Twitter.
No, no.
Okay.
I should be, but I'm not. I feel like I'm not. So you can't follow me there.
Oh, that's too bad. Now next year I'll ask you again. And
Okay, that's fair. Maybe I need to change. I'm showing my age.
no, or just maybe
Yeah,
like
it could be a
other.
good forum. Well, this is all interesting for us too. Like going public, and the market has changed in the way that you need to approach investors. So, yeah, that's a good question, and I'll reflect on it.
Okay.
But I appreciate your having me today. It was a really good discussion. Thank you very much.
No, thank you for being on, and thanks to all the listeners for checking in. So grateful for that. Please like, subscribe, and share this interview. Sounds like a really interesting company, and I'll be thinking about it. Bye bye, and thank you all.